Stocks in the healthcare sector are some of the cheapest in the market, and there's reason to believe this group could be the best to buy in 2021. In this video, I'll detail why I think healthcare stocks could boom this year, and then reveal the 5 I'm watching to outperform the market. We're talking top healthcare stocks to buy today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, stocks in the healthcare sector haven't done too badly this year, with about a 10% return, just underperforming the broader market's 14.3% return. Here among the 11 sectors, that would put it firmly in the middle for those returns. But now that performance is really hiding a split in the sector, with one segment doing really well and everyone else not so much. If you look at the top 10 stocks in the sector, it's mostly those smaller biotech names that have really gotten a big boost this year as investors rush in. In fact, that biotech group, shown here with the iShares Biotech ETF ticker IBB, jumped 28% last year. Now on the other hand, if you look at the worst 10 healthcare stocks, and really it's the rest of the sector outside of biotech, you see a more diversified picture across the industries. All those medical device makers, instruments, large drug makers, and the insurance companies. So that seemingly solid performance last year in the healthcare companies was really just a mirage from the outperformance in that one small segment, really about 14% of the sector, hiding a much bigger underperformance in the rest. So in this video, I want to look at why that happened and how to use it to get your portfolio ready for 2021. We'll look at the valuations for healthcare stocks as well as analyst estimates. Then I'll reveal the 5 healthcare stocks to buy right now for those higher returns. I'll be putting this video inside our playlist on the channel, the best stocks to buy for 2021, along with all our other 2021 picks. So make sure you check that out, check out the entire portfolio. So now, even though everything last year was about healthcare, it wasn't the kind that makes these health services companies any money. The pandemic led to a crisis where providers really had to triage their services, cutting everything that wasn't critical to make room for those COVID patients. That meant postponing or canceling all those high-margin elective surgeries and the other services that are really the bread and butter for these companies. And of course, that drought in profits flowed down into the devices, the instruments, and those larger drug makers. But as we get back to some kind of normal here in 2021, we could be setting up for that outperformance this year. This chart by FactSet shows the forward PE ratios for these stocks in each sector. So the price of the stocks in the sector divided by the earnings that analysts expect those companies to report over the next year. So that's the dark blue bar. And then the lighter blue and the green bars here are the 5 and 10-year average PE ratios. And what you see is that nearly every sector is trading more expensively than those historical averages. The dark blue bars here, those PE ratios right now, are well above the longer-term averages, but it's not quite as bad for some sectors. For example, the first 2 sectors on the left here, consumer discretionary and all the stocks in the tech sector, are trading way above those long-term PE averages. At a PE ratio of 32.2 times, consumer discretionary is 67% more expensive compared to that 10-year average, and tech stocks 65% more expensive. But then all the way over to the right, you have the financial sector and healthcare. Stocks in that financial sector trade for 14.7 times on that PE basis, just 18% higher than the 10-year average. Even cheaper though, stocks in the healthcare sector are trading for 16.3 times, which is just 9% more than the 10-year average PE ratio. So here we're already starting at a very good point on valuation for the sector as a whole, and something else here makes me think these healthcare stocks could get a big boost from sentiment this year. Now, as those higher profit services come back and companies report their quarterly earnings, they're going to have a very easy comparables from the last year, from 2020. With the big drop in earnings last year, healthcare companies are going to be able to just smash those out of the park. And this is more likely to start in the second and the third quarter. But they're going to be reporting those earnings growth of 20 and 30% range over the last year, just because last year's was so below normal, was so below average. So what I'm getting at is we could get some big earnings reports this year, like high double-digit earnings growth over the last year. It's going to look great to investors, and sentiment is going to take these companies higher and higher. Now, I want to get to those 5 healthcare stocks to watch, but I want to throw this out to the community as well. What are you watching this year? What are the sectors or the specific stocks that you're watching, and which do you think are going to do best? So just scroll down and let us know in the comments below, what are you watching and why? Getting started here, Medtronic, ticker MDT, is the leader in the medical device space. Everything from pacemakers to defib machines and those ventilators. And this company is bent on growth with 180 new product approvals and acquisitions just this year. The company reported revenue down 1.5% in the third quarter versus the year before, but up 18% over that last quarter. So already some turnaround here. And what I really liked hearing, though, during that earnings report was that management noted market share gains in several products. So I think Medtronic is taking advantage of this time to win more share against its competitors. Now, this is an acquisitive company, buying competitors besides developing its own products, so I always want to pay attention to the balance sheet and that organic growth with these types of companies. And first is because you don't want them piling on so much debt from those acquisitions that they can't handle the payments. This company has cash reserves of $14 billion against about $26 billion in debt and does $5 billion in free cash flow a year, so that doesn't seem to be a problem what we're looking at here. Now, another way to look at these, you also want to make sure that management isn't trying to cover up that weak organic growth in sales just by buying up more products and getting into more markets. So always be watching for the earnings for that as well. Earnings got crushed last year with the last 3 quarters earnings lower by 46%, so definitely one where we're looking for that recovery. Now, shares do trade for 31.5 times on that prior 4 quarters earnings of $3.66 a share, but profits are expected higher by 47% over the next year. We've still got 4 more stocks to highlight, but if you're not using the Webull app to invest yet, click through the link I'll leave in the description and you'll get 4 free stocks when you make your first deposit. It's free money, helps support the channel, so I appreciate it, and it's going to be an instant return on your portfolio. I've been using Webull for about a year now and love the stock simulator that lets me test out different ideas and strategies before investing my own money. So look for the link in the video description below and check that out. Becton Dickinson, ticker BDX, is the world's largest maker of surgical instruments and products. The company actually reported earnings growth last year thanks to its COVID testing kit, though the rest of the business slumped pretty badly. And like Medtronic, this is another one with just massive scale that can use that size to drive profits like the smaller companies just can't touch. The company has used the last year to cut costs, becoming even more profitable and raise its operating margin from an already industry-leading 13% to 14.8% margin. And what really surprised me researching BDX is that the balance sheet actually got stronger last year. And we know most companies have been borrowing billions of dollars to stay alive, but Becton Dickinson actually paid down just over $1 billion in debt and grew its cash reserves by $2.3 billion, so in a great position going into 2021. Shares are trading at 24 times earnings of $10.19 a share over the last year, but analysts expect this one to put up profits of 23% higher to $12.54 a share over the next year. Analysts have price targets from $260 on the low end to as high as $297 a share over this next 4 quarters. I included Gilead Sciences, ticker GILD, in last year's healthcare stocks, and shares were up 24% until mid-year when weakness in that HCV business started weighing on the shares. A lot of the news this year for Gilead has been around its remdesivir treatment for COVID, which probably brought in about $1.9 billion. But the pandemic has also produced headwinds for some of the company's other drugs. Even given that, though, Gilead is a leader in HIV and hepatitis treatments, 2 of the highest profit margin markets in drug making. In fact, Gilead is so successful in HIV treatments that it serves 80% of the patients in the United States. Shares trade for just 9.5 times on a $6.20 in per share earnings, which are expected 10% higher to $6.80 a share over the next year. Analysts have targets here of up to $105 a share, and I think this one continues to get a boost from those remdesivir sales even as other products start coming back up. Boston Scientific, ticker BSX, is another one of those big dogs in medical devices, specializing in cardiac and arterial implants, but with strong leadership in oncology therapies as well. There is some overlap here with Medtronic in their products, but both of these are very strong in the medical devices space, and I think it could be a great year for both of these. The shares have been under pressure lately after the company discontinued its Lotus TAVR program, which actually benefits Medtronic. And BSX has a great pipeline of new products though, and just closed a monster acquisition with BTG in 2019. So we're really going to be focusing on that growth from that combination over the next couple of years. Earnings over the last 3 quarters were down 35% over the comparable period in 2019, with those shares now trading at 29 times earnings of $1.19 a share over the last year. Profits are expected to rebound, though, 26% this year to $1.50 a share, and management has a great track record for beating these expectations. Analysts have price targets here from $39 a share to as high as $48 each over the next year, so even that low target is above the current price. Thermo Fisher Scientific, ticker TMO, another testing and instruments maker, has actually benefited from the pandemic with its PCR-based test. The company has booked upwards of $4.5 billion in COVID-related sales and expects to carry that momentum on through this year. While that revenue will start to fade later on in the year, this is another one with that wide lineup of products across healthcare and is always developing new ones. Even after that strong revenue growth last year, the company is expected to drive earnings higher by 33% this year to $21.23 a share, which would put the shares right around 21 times on that forward PE basis. Analysts have targets from $480 a share on the low end to as high as $570 each over the next year. Click on the video to the right for the 5 penny stocks I'm buying for 2021. 5 companies with the potential for massive growth. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.